Good afternoon everyone. So I'm back with one more video for you. We are going to discuss about the IL&FS case law. We have discussed it in the video 1 also, but in that video we have discussed about the applicability of NAFRA on specific companies and how engagement partners of Deloitte have been penalized in this case law. So we are going to discuss here about detailed case study of the IL&FS. Video number 2. So in this video we are going to discuss why they have been penalized. The main reason of their penalty was they do not comply with the standards on auditing. As per section 143 subsection 9 of Companies Act 2013, they are required, the engagement partners, the auditors are required to comply with the auditing standards. Instead, they were complying with the international standards, which are of no use. As per section 143 subsection 9, we auditors are required to comply with the standards on auditing, which the Deloitte auditors do not comply with. So in this, as well as they do not apply their due diligence, they were grossly negligent while performing their auditing procedures. So one more reason of their penalty was that they do not calculate the net owned fund for the as per RBI directions. IL&FS was an NBFC. They are required to comply with Companies Act 2013 as it was a company, as well as RBI directions also, because it was an NBFC. As per RBI directions, they are required to comply with the net owned fund. Their net owned fund was minus 4123.76 crores on 31st March 2016 as compared to 45.93 crore as on 31st March 2015. So there was a big difference in 31st March 2016 and 31st March 2015. So it was a clear evidence of risky management practices. Auditing firm should have worked out the net owned fund as on 31st March 2017 and 31st March 2018 to make the assessment of the compliance with the law by the auditor. However, firm failed to do so. Which firm? Auditing firm. Auditing firm here means Deloitte, resulting in an underestimate risk categorization of the auditee. Who was the auditee? IL&FS. By the auditor. Who was the auditor? Deloitte. So RBI assessment of gross NPAs. NPA means non-performing asset. It was substantial higher than reported gross NPAs, and RBI had asked the IL&FS to submit their detailed submission to these inspection observations regarding NPA. RBI was telling again and again to the Deloitte to give their detailed responses regarding NPAs. In spite of such evidence on record, the Deloitte taking the list of NPAs provided by the management as given and subject only the interest recognition and calculation in these accounts to verification. However, the basic question whether list of NPAs provided by the management, was it comprehensive and did not leave out any case that needed to be considered subject to testing. So in accordance with the para 12 of SA 240, Deloitte auditors, engagement partners, Udyam Sen, Shrenik Bed, they should have maintained the professional skepticism throughout the audit, recognizing the possibility that material misstatement due to fraud could exist in the areas of revenue recognition and NPAs, as detailed we have discussed earlier also. So auditors, engagement partners, past experience of honesty and integrity of the IL&FS management and those charged with governance. So the engagement team, the 3 engagement partners, was grossly negligent in performing adequate audit procedure wherever required. They do not apply the substantial audit procedure to evaluate the risk of material misstatement on account of management override of control in the areas of loan sanctions and disbursement. Obviously, IL&FS was an NBFC. they were subject to require the loan sanctioning and disbursement, which is the core business of IL&FS. So we have to report it was very clear evidence of negligence on part of these engagement partners while performing adequate audit procedures. So they are required to comply with the SA 315. They were grossly negligent. So the fact that a manual override of controls had to be undertaken by the IL&FS. It is the indicative of the need to relax the conditions of viability, creditworthiness of the borrowers, as it was an NBFC. So it's the core business of IL&FS. Collaterals require in the specific cases. This would have clear analysis of the credit appraisal memorandums. The audit file does not provide any evidence in support of procedure performed, and the credit appraisal memorandums scrutinized to understand the reason for manual override of controls in specific cases of loan sanctioning by the IL&FS. So it was clear indication that something was wrong. To this extent, the large number and proportion of value of manual overrides was a fraud risk that was not met by the adequate response in terms of the audit procedures conducted. This was subsequently brought out by the RBI, also in its report dated 22nd March 2019. Being one of the partners, CA Schrening had failed to exercise due diligence in exercising his judgment to identify fraud risk as mandated in SA 315. Thus, CA Schrening, one of the partners responsible for the conduct of audit, grossly failed in evaluate the ROMM. ROMM means risk of material misstatements in the financials audited by them. It also violated the SA 240, SA 200, SA 315 and RBI direction. So Schrening failed to draw up and implement an audit plan to satisfactorily address the ROMM. He failed to obtain sufficient info with respect to NPs and manual override of controls for loan sanctioning. As we discussed earlier also, failed in evaluating and reporting the NOF, net owned funds, failed in noting the special status of the auditee, and failed in proper risk categorization of IL&FS. Despite this, omission, which are otherwise necessary matters for expression of opinion, as we all know, what's the work of auditor? To express an opinion on the financials. So the Deloitte went ahead with giving his unqualified opinion on the financials of IL&FS, which they do not do, they also violated the compliance of SA 240, SA 200 and SA 315 as we discussed earlier also. So they were grossly negligent in the conduct of their professional duties. So it was their failure to obtain sufficient information which was necessary for expression of an opinion or its exceptions are sufficiently material to negate the expression of an opinion. Failure to exercise due diligence and grossly negligent, they were also professional misconduct under the clause 7 of part 1 second schedule of CA Act 1949. So there is non-compliance with the applicable standards on auditing prescribed by section 143 subsection 9 as we discussed it in the starting of this video.